credit reporting agencies started back in 1981, and it consists of an algorithm that can be confusing. In order to improve your credit score, it first helps to understand what it is that makes up the score. So FICO scores range from 300 to 850. There's two other types of FICO scores. It's a bank card score and an auto score, and those can range from 250 to 900. And FICO scores break down into 5 ranges: exceptional, very good, good, fair, and poor. An exceptional range, you're considered a super low risk, and it ranges usually around 800 to 850. You can see it on the right-hand side of your screen. Very good. Basically, if you're over 740, if you're very good or exceptional, it's not really going to change the interest rates that you're going to get on loans for cars, homes, or approval on credit cards. Good, it drops a little bit. You're still not considered a credit risk, but you're mid-range. Fair and poor, you've got some issues there, with poor making it very unlikely that you're able to secure new lines of credit. 5 things that make up your credit score. First, we'll talk about credit mix, and there's a couple different types. Credit cards, they fall into what's called revolving credit. Every time you clear a card, it's still available to you. That line of credit is still open to you. HELOC on the house of your dreams, mortgage, car loans are installment types of credit. And another, which is kind of rare, is like American Express, where you have the ability to borrow money, but at the end of the month on the last day, it's expected that you're going to clear the credit. The second area that affects your credit score is credit utilization. Credit utilization, you basically want to keep it around 30%. The better number in order to have those extreme credit scores is to have it around 10%. This is a great area to improve your score, so what we'll do is we'll take a look at a couple of credit card examples. Remember, you want to stay under 30% utilization, under 10% for the best scores, 30% for good scores. If my credit limit is $30,000 on 3 cards and the balances are $3,000 on each card, I'm only using 10% of my available credit, so the utilization is only 10%. In case 2 here, if I have 0, 0, and 3,000 on the third card is over 30% utilization, but my overall credit utilization across the 3 cards is still only 10%. Not as good as the first example, but still pretty good. Now, let's say that we increase the balance on the third one to $4,000. Now we're over 10%, but we're still under 30% for the overall credit utilization. It's not the 850 credit score situation, but it's still pretty good. What you can do here is you can contact the credit card company and see if they'll increase your credit limit on the card that has the 4,000 balance, and then that would certainly change the credit utilization to a lower percentage. In this last situation, I have a credit limit of $30,000 and I'm using $3,000. That's 10%. Not a problem, but if I eliminate one of the credit cards, that changed the balance. So closing out one credit card can change your credit utilization percentage, so be careful about what your balances are with available credit. Before we continue, please consider subscribing and liking the video. Please put any comments you have down below. The third area that makes up your credit score is payment history, and this one accounts for 35%. Because of how high, this is the highest area that can hurt your score, don't ever be late with a payment. It's a simple thing to do. Just go online when you get your credit card and set up automatic payments to be withdrawn from your bank. Keep in mind that if you don't make the payment because you're overdrawn and insufficient funds, they still count that as you missed a payment. This is the biggest area, so you have to be the most careful with it. The next one, which you don't have a lot of control over, is the length of credit history, and it makes up 15% of the overall credit score. The length of credit history, the oldest that your credit is, for example, for some people that might be the mortgage on your house. In your 25th year of your mortgage, your oldest credit is going to be 25 years old, but when you pay your house off, that goes away. If you refinance, it goes away. Same thing with a car loan. If you take out a 5-year car loan, at the end of that, that goes away. The one area where you can probably keep credit the most would be with a credit card. I think I have a credit card now over 30 years. I do not ever want to close that card out because the length of my credit history would take a hit in this area. It's not super strong, but it still counts. So don't close out your oldest card. Having them open is not going to hurt you, but rather help you by increasing your credit limit. Let's look at the fifth area is the number of credit inquiries. Credit inquiries are called soft or hard hits. Hard hits are really bad ones. An example of a soft hit is if you get an offer from a credit card or for a loan that says you're pre-approved. If you're factually pre-approved, they don't have to do a credit check on you. A hard hit would be you're opening a new mortgage, you're buying a car, 5-year loan, you're opening up a new credit card. These are hard hits, and if you get too many within a 2-year period, FICO can interpret that to mean that you're having financial troubles. Each hard inquiry costs about 5 points off your score, and a hard inquiry can remain on your credit report for up to 2 years. New car loans, new home loans, mortgages, and home equity line of credits and credit cards are examples of hard hits that affect your credit score. If there's negative information in your credit report and it shouldn't be there, and sometimes even if it is there and it's supposed to be there, things can get updated. You can dispute errors in your credit report, and the credit reporting agencies have 30 days to conduct an investigation. If they don't get back to you in 30 days, they have to remove that from your credit report. If there is negative information and it's supposed to be there, but you've updated it by making late payments are better than no payments. That would be a good thing for you to contact them and have that updated because it could potentially raise your score. On the Equifax website, they're one of the 3 reporting agencies. A question was asked, is there a grace period for a late payment, say with a credit card? Credit reporting agencies don't report unless a payment is greater than 30 days past due. And while you can still incur late fees, this is something to look into. One time I got a new credit card, and about a week or 2 after I had the credit card, I went on to their website to have them take the automatic payments from my checking account. Lo and behold, I missed the number of days necessary for that to become active, and I didn't catch it until it was 3 or 4 days past the payment due date. When I called the credit card agency, they said that unless it's more than 30 days, they don't report it to the agency. They also didn't charge me late fees because they see that I did, in fact, activate automatic payments on the website. So it's just another thing that you should take into account for grace period and, how many days you have until a payment is considered late. Something that can cause an unexpected drop to your credit score is when you clear an installment type loan. Let's say that you have a mortgage, no car loan, and you have credit cards. You have 2 of the 3 types of credit in your credit mix, which accounts for 10% of your overall credit score. So if you clear the loan, your credit mix diversity changes, and as a result, your credit score can take a temporary drop. When I paid off my house, it was a drop of about 30 points or so, and I'm told that's temporary.